Finance Committee will come to order. The Finance Committee meets this morning to discuss the Byzantine, intricate tax schemes of some of the largest U.S. pharmaceutical companies and the immense handouts that these companies got from the 2017 Republican tax law. In short, it goes like this. When most Americans travel to some faraway land, they get a suntan. When Big Pharma's profits travel overseas, they get a really big tax break. The tax break got a whole lot bigger as a result of those 2017 Republican reforms. 2 years ago, the Finance Committee Democratic staff began investigating these issues. We asked 5 big pharma companies for answers to questions that really are pretty straightforward. They're not complicated. Where do you make your sales? Where do you report your profits? Where do you stick your intellectual property? The reality is, these are not nuclear secrets, but big pharma pulled out all the stops to keep the details of their tax schemes hidden in the shadows. Nonetheless, the committee is updating the public on our ongoing investigation today. Here is what Big Pharma doesn't want the American people to know about. Our investigation obtained data from the Joint Committee on Taxation, and of course, they're the nonpartisan experts, on the effective tax rates the largest pharmaceutical companies paid before and after the Republican tax law went into effect. The numbers are eye-popping. Republicans delivered Big Pharma a tax cut of more than 40%. From 2014 to 2016, the industry paid 19.6% on average. In 2019 and 2020, it paid 11.6%. Pharma got a substantially lower tax rate than most industries, specifically because the 2017 Republican tax bill essentially green-lighted the kind of tax gaming that the biggest drug companies pursue day in and day out. They stash their intellectual property in other countries. They stick manufacturing offshore. They use accounting tricks to shift money to foreign subsidiaries. Republicans in that tax bill could have put a stop to these tax games. They didn't. Here's what makes this so appalling for taxpayers and all of the patients who are waiting in line for affordable medicine. The U.S. is by far the biggest market for these drug companies. For some companies, this is where they do the vast majority of their sales. For Amgen, it's 74%. For AbbVie, it's 72%. These are American companies selling to American patients who we have the honor to represent here in the Senate. But their profits show up somewhere else. Amgen reported 60% of its profits offshore in 2019. AbbVie reported 100% of its profits offshore. Colleagues, think about that number, 100%. In many cases, these companies charge American patients and taxpayers staggering amounts for prescription medicine, sometimes double, triple, quadruple what they charge in other countries, and then report the profits on these huge U.S. sales somewhere else. For example, the list price for Keytruda, a cancer drug produced by Merck, is $175,000 per year. Merck sold more than $37 billion of the drug in the U.S. between 2019 and 2022. According to the committee's investigation, Merck reported virtually all of the profits on the sales overseas. The level of profit shifting industry-wide is enough to leave you slack-jawed. According to the Joint Committee on Taxation, colleagues, this is not made up by some group that has partisan views. According to the Joint Committee on Taxation, Big Pharma reports 75% of their income offshore. The update to our ongoing investigation, which the Finance Committee made available this morning, goes deeper into specific cases of Big Pharma's tax games. That information is available to the American people to read on our website right now. Without objection, I'll enter a copy of our record and the accompanying JCT analysis into the record. Now, I'll close by saying there's a big interest on our side of the aisle in fixing this broken system, cracking down on tax gaming and ensuring that these big corporations pay a fair share. In 2021, Senator Brown, Senator Warner, and I introduced a comprehensive proposal that addresses all of the issues that the committee is going to discuss today. We spent a lot of time on putting together the Brown, Warner, Wyden proposal to deal with the kinds of questions we're talking about. Senator Whitehouse has been a leader on this topic. Obviously, Treasury Secretary Yellen has led a major effort to crack down on tax schemes all over the world. So obviously, the Finance Committee's got a lot to discuss today. I look forward to hearing from our witnesses. Let me recognize our friend, Senator Crapo.
Thank you, Mr. Chairman. Almost 8 years ago, before the Republican-enacted Tax Cuts and Jobs Act, this committee's bipartisan working group concluded our international tax system was clearly broken. Inversions were on the rise, used as a defensive strategy by U.S. companies to fend off foreign takeovers. Mr. Chairman, you rightly observed this inversion virus was multiplying every few days. Ironically, the bipartisan report cited the pharmaceutical industry to illustrate how the pre-TCJA tax code made U.S. companies more valuable in the hands of foreign acquirers. In seeking to put TCJA on trial, today's hearing ignores facts that have flipped the competitive edge in our favor. Fact: TCJA completely cured the inversion virus. By enacting competitive tax rates and reforming how we tax foreign income, U.S. companies and their workers can now win in the global marketplace. Prior to the pandemic, TCJA's reforms led to one of the strongest economies in generations. Unemployment dropped to a 50-year low. Economic gains flowed to all demographic groups and income levels, and American businesses reported record R&D investment. But TCJA was far from a corporate giveaway. It significantly broadened the tax base, including introducing the first global minimum tax of its kind. The result of that prescription? Record high tax receipts. I'll say that again. Record high corporate tax receipts. In short, TCJA is a vast improvement over the prior system. Of course, we should not rest on our laurels. In the changing global landscape, we should consider refinements that would allow U.S. companies to further invest and expand domestically without harming their ability to compete globally. Cherry-picking data from an industry to defame the TCJA ignores how the threshold question has dramatically changed since 2017. No longer is the question whether our tax code drives our companies overseas, costing American taxpayers billions. Rather, the critics' chief complaint now appears to be that the U.S. fisc deserves a bigger slice of the success that our companies are now able to achieve, in large part due to TCJA. I agree we should examine how international tax policy impacts our tax base, while ensuring we remain an attractive place for investment to boost our workers' jobs opportunities and wages. In that context, Congress must seriously examine the commitments this administration has made in OECD international tax negotiations. The last two-plus years, this administration has used those negotiations in an attempt to compel domestic law changes, disregarding the effect on U.S. revenue, companies, and workers. Without consulting Congress, much less obtaining its consent, it collaborated with the OECD on a cartel-like global tax code with a trilogy of new taxes which appear to put America last. The first piece mandates a global minimum level of tax on large companies. The U.S. already has one, thanks to the TCJA. But at our own administration's urging, it was not deemed good enough for the new world tax order. The second is the enforcement mechanism, the UTPR. This extraterritorial tax greases the skids for a foreign revenue grab and blatantly undermines important job-creating tax policies passed by a Congress on a bipartisan basis. And the final one drains the U.S. fisc. The global tax code sanctions a pathway for domestic minimum tax, and Treasury agreed to give priority to those taxes over the TCJA minimum tax, essentially handing each foreign country a model vacuum to suck away tens of billions of dollars from our tax base. But the most indefensible position agreed to by Treasury, the disparate treatment of investment incentives for each tax in the trilogy, tilting the scale in favor of our competitors. Investment incentives historically enacted by Congress, for example, the non-refundable tax credits such as the R&D tax credit, are treated punitively by the UTPR compared to refundable tax credits and government subsidies more commonly used in other countries. In other words, the OECD high priests have condemned tax competition but blessed government subsidies. That's why the administration's narrative of the global tax code halting the so-called race to the bottom rings quite hollow. In reality, if one adopts that rhetoric, the global tax code creates a more supercharged race to the bottom, a race for increased subsidies in government-favored industries. Even President Biden's former lead OECD negotiator recently acknowledged this. Maybe most concerning is which country may benefit the most from this failed game of whack-a-mole. China bestows hundreds of billions of dollars in subsidies every year upon its favored domestic companies, and they do it far better than any other developed country. Given the administration's failure to subject this deal to careful public scrutiny and analysis, this global tax code could result in an America Last policy that cedes ground to China. Congress should seriously probe whether the administration agreed to a global tax code that materially harms our businesses, workers, and the fisc. In the interim, Mr. Chairman, I look forward to hearing from today's witnesses on their perspectives on international tax challenges that we face in this global economy.
Thank you, Senator Crapo. The first witness is Brad Setzer. He's a senior fellow at the Council on Foreign Relations. Previously served as the senior advisor to the United States Trade Representative and as the Deputy Assistant Secretary for International Economic Analysis in the Treasury. The second witness is Daniel Bunn. Mr. Bunn is president and CEO of the Tax Foundation, where he's worked since 2018. Previously, he worked in the Senate as the Joint Economic Committee individual leading on these kinds of questions, and he's also worked for Senator Mike Lee and Senator Tim Scott. Our third witness is Diane Ring, international tax expert and professor of law at Boston College. She also worked as a consultant for the UN's project on tax-based protection for developing countries. The fourth witness is William Morris. Mr. Morris is PricewaterhouseCoopers Deputy Global Tax Policy leader. He also worked at GE working on these issues as well. Our witnesses bring an awful lot of experience on these kinds of international policy issues. We're glad that you could be here today. I'd like to ask you all to keep your remarks to 5 minutes or so, and we'll put your full statements into the record. Mr. Setzer, please go ahead.
Chairman Wyden, Ranking Member Crapo, distinguished members of this committee, it is an honor to testify here today. I am Brad Setzer, as noted. I'm a senior fellow at the Council on Foreign Relations. Tax avoidance by American pharmaceutical companies is a very real problem. Most of America's leading pharmaceutical companies currently have structured their businesses to shift profits from their U.S. sales to their offshore subsidiaries. In order to shift profits abroad, many of these companies have offshored production and jobs at a real cost to our biopharmaceutical manufacturing base. Tax avoidance by American pharmaceutical companies is also a very solvable problem. Straightforward changes to the U.S. tax code would encourage American and global pharmaceutical companies to onshore rather than offshore their global profit and to produce more patent-protected pharmaceuticals in the United States. My testimony divides into three parts. The first examines the incentives in the tax code that favor offshoring. The second reviews empirical evidence of profit shifting in the pharmaceutical sector. The third lays out needed reforms. The 2017 Tax Cuts and Jobs Act changed the structure of the U.S. tax code without, unfortunately, changing the underlying incentive to move profit and jobs offshore. The tax system put in place in 2017 was designed so that income earned in the United States would be taxed at a 21% rate, and income earned abroad would typically not be subject to U.S. tax. In an enormously inadequate attempt to build guardrails against the abuse intrinsic to such a system, the U.S. Congress created two special tax regimes, a 10.5% GILTI tax on some global profits of U.S. companies, and a special U.S. tax preference for export earnings above 10% on U.S.-based tangible assets. By institutionalizing a large gap between the headline U.S. corporate tax rate and the low GILTI rate, the new tax code generated strong incentives for firms to continue to transfer production and profits abroad. My friend, Dr. Kimberly Clausing, has rightly called this an America Last tax policy. The reform structurally favored foreign income over domestic income. Thus, the last place an internationally mobile firm will want to book its profits on its tangible assets is in the United States. 5 years have passed since this reform was enacted. The results are clear. They are particularly clear in the pharmaceutical sector. A systematic examination of the annual financial reports of 6 large U.S.-listed pharmaceutical companies shows that this set of companies reports $215 billion in U.S. revenue in 2022. This set of companies reported earning only $10 billion in U.S. profits. The same companies generated $170 billion in revenue abroad and reported only $90 billion, or reported amazingly $90 billion, a huge sum on those profits. Of the $100 billion in global profits earned by American pharmaceutical companies in 2022, they appear to have paid about $2 billion to the U.S. Treasury. The U.S. trade data tells the same story. The U.S. now runs a massive trade deficit in pharmaceuticals, largely with countries like Ireland, Singapore, Belgium, and Switzerland. Major U.S. pharmaceutical companies have announced significant new investments in Irish production, often explicitly for the U.S. market. Given that the Tax Cut and Jobs Act only reinforced prior incentives to offshore pharmaceutical production and profits, I unfortunately do not think it is unfair to call the Tax Cuts and Jobs Act the Pharmaceutical Tax Cuts and Irish Jobs Act. There are a number of reforms that are necessary to change the incentives in those systems. They are outlined in detail in my testimony. They very much align with the proposals put forward by Senators Wyden, Warner, and others. To conclude, there's an urgent need to reform the U.S. corporate tax code, both to assure that some of America's most profitable companies pay their fair share and to strengthen our industrial base. Americans pay the world's highest prices for life-saving medicines. American companies should not systematically shift the profits on those sales out of the United States. I applaud the members of the Finance Committee for calling this hearing. Thank you.
Thank you very much, Mr. Setzer. Mr. Bunt, welcome.
Thank you, Chairman Wyden. Chairman Wyden, Ranking Member Crapo, and distinguished members of the Senate Finance Committee, thank you for the opportunity to testify today. I'm Daniel Bunn, CEO and President of the Tax Foundation. Washington's attention is understandably on the debt ceiling, but Unless we protect the nation's tax base, it will make our efforts to achieve fiscal sustainability that much harder. Today, if you're concerned about U.S. companies paying a certain amount of tax to the U.S. government on their foreign profits, then you should focus on what the U.S. Treasury Department has agreed to at the OECD, which directly reduces the amount of taxes U.S. companies would pay to the U.S. government on their foreign operations. Other countries, particularly in Europe, have often eyed U.S. companies with the desire to tax their profits. There was bipartisan concern in this committee when the digital services taxes were introduced, exposing U.S. companies to extraterritorial taxation. Now, the current global minimum tax rules do just that. They expose U.S. companies to extraterritorial taxation. Today, I'll share my views on the effects of the reforms brought in by the 2017 Tax Cuts and Jobs Act. Then I will discuss tax uncertainty that is connected to the global minimum tax rules. And finally, I will talk about a strategic approach to changing U.S. cross-border rules. The 2017 tax reforms weren't perfect, but they moved the U.S. in the right direction. In the 5 years immediately following the TCJA, companies repatriated $2.1 trillion in foreign earnings. Intellectual property was also reshored. One indicator of this is exports of IP services to foreign jurisdictions, particularly to Ireland. From the start of 2020 to the end of 2022, Irish entities imported $268 billion worth of IP services from the U.S., more than triple the amount in the prior decade. Much of the IP that has been shifted back to the U.S. has come from offshore financial centers such as Bermuda and the Cayman Islands. Leading up to the passage of the TCJA, we saw dozens of U.S. companies move their headquarters outside the U.S., the so-called inversion wave. Since tax reform, the inversion wave has all but stopped, as the competitiveness of U.S. headquartered companies has improved. Now, however, companies and lawmakers are facing significant uncertainty stemming primarily from the global minimum tax rules. These rules do not match U.S. tax rules, and many U.S. companies are preparing to comply with them, representing yet another layer of minimum taxes on U.S. multinationals. Additionally, foreign top-up taxes are likely to undermine U.S. tax incentives through rules that give away our tax base to foreign jurisdictions. And the global minimum tax rules that Treasury has agreed to also undercut the revenue that GILTI, the tax on global intangible low-tax income, would raise by allowing foreign top-up taxes to stand in front of GILTI. While Treasury has not sufficiently coordinated its international negotiations with Congress, it will be Congress's responsibility to minimize the disruption caused by the implementation of this global minimum tax. 3 goals should guide lawmakers. First, simplify the taxation of U.S. multinationals. Second, promote investment and innovation in the U.S. in ways that protect the U.S. tax base from foreign top-up taxes. And third, aim for revenue-neutral reforms. The tensions between our hybrid system that is neither truly territorial nor worldwide and layers upon layers of anti-avoidance rules, this tension will create complexity and enforcement challenges for years to come. Congress should aim for reforms that maintain competitiveness and simplicity while avoiding friction between U.S. rules and foreign minimum taxes. This should be done alongside permanent, growth-oriented reforms like returning to expensing for research and development costs and capital investments, and maintaining a competitive corporate tax rate. To prevent companies that operate in the U.S. from losing tax benefits to foreign top-ups, Congress should review, this committee should review existing tax credits and prioritize them for reform or elimination. Additional tax revenues from eliminated tax incentives could be used to extend investment-friendly policies that are more compatible with the global minimum tax, such as full expensing for capital investment. Again, as difficult as it might seem, Congress should aim for revenue-neutral reforms. The international tax system can and should be simplified. Even in the face of a global minimum tax, Congress has a chance to develop a strategic approach in support of U.S. investment and innovation, and it should take that chance. I look forward to your questions.
All right. Next is Diane Ring. Welcome.
Good morning, Chairman Wyden, Ranking Member Crapo, and distinguished members of the committee. My name is Diane Ring, and I'm a professor at Boston College Law School. Thank you for the opportunity to testify before you today. The 2017 Tax Cuts and Jobs Act dramatically reduced U.S. corporate tax rates and pursued a mixed policy of exemption and current taxation of foreign income that failed to end significant profit shifting. New tax rules rewarded U.S. businesses for making investments offshore. The GILTI regime was introduced as a floor or a minimum tax on the most mobile of U.S. multinationals' foreign income. However, notable design features severely hampered its ability to function as a meaningful minimum tax, a costly failure given the significant reduction in corporate tax rates and the even lower U.S. rate of tax on much foreign income. As other testimony explores in more detail, U.S. pharma companies have reported low ETRs on book income, with much or most income being reported offshore despite being generated by sales to U.S. customers. The next rounds of tax reform in the United States should increase revenue from those with the ability to pay and recognize the ongoing capacity of U.S. multinationals to strategically offshore, to minimize their income taxes in ways not consistent with broader U.S. tax policy, and to accomplish these feats while profiting from a predominantly U.S. market base. But in this next round, the U.S. will not be alone. GILTI served as a springboard for the international tax community to collectively pursue, design, and ultimately agree to a stronger global minimum tax under Pillar 2. The version articulated by the designers of GILTI in 2017, a minimum tax to curtail serious profit shifting, was one that more than 140 countries ultimately signed onto and tried to improve upon. Not surprisingly, any agreement in the tax and fiscal arena involving over 140 jurisdictions will inevitably entail compromises and complexities. But the feat was notable, as we can appreciate, given the challenges domestically in reaching bipartisan agreement on budgets and debt limits. To ensure that these achievements are not wasted, that U.S. multinationals cannot avoid tax on significant returns, and that the U.S. secures important tax revenue streams, tax policy reform in the United States should focus on strengthening GILTI and revising the rate structure. Questions about the revenue implications are valid, but they need to be focused on the right issues. Global adoption of Pillar 2 should result in other countries taxing businesses operating in their jurisdictions, including U.S. multinationals. This is a global minimum tax regime operating as it should, providing a floor, leveling the playing field, eliminating a race to the bottom, and enabling countries to collect corporate tax from businesses operating in their jurisdiction. The Pillar 2 implementation timetables of the European Union, South Korea, and a host of other jurisdictions have resolved the question of international commitment and now enable the U.S. to work towards establishing minimum tax rules that successfully curb profit shifting and base erosion. But the United States also benefits as other jurisdictions who historically have struggled to collect meaningful corporate tax revenue from multinationals operating in their own country are finally able to do so. The tax on income earned by foreign multinationals operating in these other countries is legitimately these countries' tax revenue. Additionally, U.S. security, economic, and strategic interests are furthered by these countries' ability to collect their tax revenue. When other countries face ongoing tax revenue constraints, they are limited in their capacity to address critical issues, including economic stability and growth, climate change, democratic functioning, and political security. Failures on these fronts generate flows of economic migration, fragile and potentially concerning political states, and fewer partners to help combat the serious global issues facing the United States in the coming decades, including climate-related health and economic disruptions, pandemic and global health issues, and wars of aggression. In no way is the United States' future improved by continued existence or proliferation of states unable to respond to these problems or to meet the needs of their citizens, residents in the world. Finally, as countries adopt Pillar 2, less income should be shifted out of the United States, thus increasing U.S. tax revenues. The United States almost certainly is a net revenue winner from other countries' adoption of Pillar 2. Adoption of the administration's proposals would assure that this is the case. Thank you, and I would be pleased to answer any questions the committee may have.
We will have some momentarily. Mr. Morris.
Chairman Wyden, Ranking Member Crapo, and distinguished members of the committee, my name is Will Morris, and I work at PwC. I appreciate the opportunity to appear this morning to testify as the committee considers important international tax questions. I appear solely on my own behalf and not on behalf of PwC or any client, and the views that I express are my own. My testimony is focused on the OECD's two-pillar project, which would reallocate more taxing rights to market jurisdictions and establish a global minimum tax of 15%. My testimony describes the two pillars, their impact on the United States and US companies, issues in how the two pillars operate, and the need to address those issues, particularly for Pillar 2. I'll start with three key points. First, the desire on the part of market countries for the right to tax global profits that gave rise to Pillar 1 will not go away and must be addressed, whether or not Pillar 1 is broadly adopted. Second, Pillar 2 is now being implemented in the EU and a number of other countries. There are ways in which it disadvantages the United States, but opportunities do remain to address those issues and create a better functioning system. Finally, we need to find a balance between international cooperation and national sovereignty. Measures preventing conflicts between countries' tax systems are important, but so is the ability of each country to use their tax system to meet the needs of their citizens, including to foster economic growth, create jobs, and protect national security. There are three issues for the US with Pillar 2 covered in my testimony. The first is the large divergence between Pillar 2 and US tax rules, in particular with respect to the treatment of US tax credits and incentives, such as R&D and energy incentives. Pillar 2's favorable treatment of credits is limited to refundable credits and cash grants. If credits aren't refundable, they are treated as reducing a company's tax paid, thus increasing the exposure to tax in other countries. Congress, of course, took a different approach when faced with the same design issue when CAMT was enacted last year. So, further global consideration is needed of credits and incentives under Pillar 2. The second issue is the undertaxed profit rule, or UTPR, which, after changes in December of 2021, no longer requires a deductible payment from a high-tax country to a low-tax country. Instead, under this modified rule, every country in which a group operates can tax income arising in other countries, including in the home country of the group. This, effectively, allows other countries to tax US credits and incentives. And the third issue is the ordering rules with respect to qualified domestic minimum top-up taxes, or QDMTTs. Under rules issued earlier this year, the QDMTT in another country will apply before GILTI, so US GILTI revenue will decline. On Pillar 1, the basic issue is a lack of widespread agreement on some key issues. This means that Pillar 1 will be hard to implement in the short term, but if it is not in effect by January the 1st, 2024, we face the prospect of a new round of digital services taxes, DSTs, largely focused on US corporations. So, what can we do? While the talks are ongoing, change is still possible, and I am completely convinced that the active engagement of this committee could play a vital role in bringing about that change. I offer three suggestions for your consideration. First, the foreign taxation of home country income under the UTPR because of non-refundable credits has to be solved. Congress, Treasury, and other countries must all be involved in this. The most promising route may be agreeing a safe harbor that treats R&D and energy credits as qualified under Pillar 2, or a safe harbor that exempts home country income, based on a number of factors, including home country statutory tax rates and a domestic minimum tax such as CAMT. This will need hard work, but is preferable to a tax or trade war. Second, we still need to address the calls for allocating taxing rights to market countries in a digitized world. For this, there first needs to be a comprehensive discussion, however, of the rationale underlying the right to tax. What gives that right, and what creates value? That is something that the Treasury, with this committee's encouragement, including through hearings, could undertake. Finally, we must ensure that in any future negotiation, that Congress is fully involved in helping shape the parameters for Treasury's negotiating position. Only then can the Treasury and other countries have a realistic view about what can be achieved in the United States. Given Congress's constitutional role in the origination of tax legislation, I suggest that there needs to be a formal way for the Congress, including this committee, to provide direction to the Treasury over such negotiations. Senators, it is still vastly preferable that we sort out these problems by agreement rather than find ourselves in a conflict. And I believe that this committee and the Congress can play a vital role in advancing that goal. I thank you for holding this important hearing. for the privilege of appearing, and I look forward to your questions.
Thank you very much, Mr. Morris, and we'll have questions for all of you. I was home last weekend in Oregon, having opened to all town hall meetings, something that I've done throughout my time in public service. And I told my constituents that we had just completed a report that indicates that the big pharmaceutical companies pay lower tax rates than the school teachers that live in their neighborhood. And people are just kind of stunned to hear it put that way. And Mr. Setzer, you did an excellent job laying out so much of what we're dealing with here. The investigative team for the committee spent 4 years looking at these issues. And they found that Merck sold $37 billion worth of Keytruda, which is the important cancer drug, to patients in the United States at a price of $175,000 each year per patient. Now, this is an American company selling to American patients, yet little to none of the profits showed up in the United States. Virtually every dollar was offshore, and the story was essentially the same for these other big pharmaceutical companies. Why don't you, because a lot of this complicated tax lingo doesn't really resemble English. I mean, it is so complicated and Byzantine. So tell us in something that those folks who came to my town hall meetings and come to other sessions around the country will understand in response to the question, how is it possible that none of Merck's Keytruda profits show up in the United States?
Senator Wyden, that's a great question. I think I share the sense of outrage expressed by your constituents about this very fact. With Merck and with Keytruda, we actually have a pretty good idea of the ways in which Merck moves profits earned on U.S. sales out of the United States. My understanding is that Keytruda was developed out of research that was done in the United States. It was actually done by a small Dutch company. Merck bought that company and apparently kept the intellectual property in Europe, perhaps in an innovation box in the Netherlands, perhaps shifted it to another low-tax jurisdiction. We don't know. Pharmaceutical companies don't like telling us. But we do know, based on this example, based on AbbVie, which moved Humira's patents to Bermuda, we know the basics. The first step is to move the intellectual property out of the United States, one way or another. The second step is to produce the drug in a low-tax jurisdiction outside the United States. Merck produces Keytruda in Ireland. The Central Bank of Ireland actually has issued a report that warned that Ireland was relying so heavily for its export revenues on a small set of patent-protected drugs that it was a future risk to the Irish economy. A number of U.S. pharmaceutical companies are increasing their investments in Ireland precisely to sell back into the U.S. market. Now, when those drugs are sold back to the U.S. market, they've already been inflated and marked up. They already have that really high price, and the profit is attributable to the subsidiaries outside the United States. The U.S. only collects the guilty tax revenue on that. The bulk of the available tax revenue right now is already being shifted to Europe. That's why out of the $100 billion of profits that the 6 large pharmaceutical companies that report detailed data, that $100 billion, they only pay about $10 billion in tax on it. And $8 billion of that tax was not paid here. It was only $2 billion was paid here. That's a real problem. It's not a future theoretical problem with Pillar 1 or Pillar 2. Those are the kind of problems that Pillar 1 and Pillar 2 are meant to solve, then can solve. So I think I do share that outrage.
Well said. Question for you, Ms. Ring. You know, there was talk about cherry picking a little bit. Joint Committee on Taxation doesn't do any cherry picking. They do it by the book. And they provided us data showing that the average tax rate of large U.S. pharmaceutical companies declined by more than 40%, 40% after enactment of the Republican 2017 tax cut. So this, of course, was a deficit-financed Republican tax cut. The big pharma companies pay a tax rate of less than 12%. Some have tax rates in single digits. The teachers and small business owners that I'm honored to represent that come to town meetings, they pay higher rates than these multi-billion-dollar multinationals. Question for you, Ms. Ring. Republicans said that their transformation and international tax work would pay off for the American people. But the evidence shows massive tax cuts, offshoring, and tax avoidance by the pharmaceutical industry. Do you agree that it is the 2017 tax law that led to these ultra-low tax rates for the big pharma companies?
Thank you for the question. It's clear that pre-TCJA, we already had profit shifting, but TCJA, the 2017 Act, made a number of additional moves that contributed to the increasingly low ETRs that we're seeing. And I'll just highlight four. First, as we've heard already, the significantly lower corporate statutory rate brought down to 21%. And then three features in the design of GILTI. First, the ability to have an initial chunk of income taxed at a 0% rate. That's your QBI, so 0. Then, in theory, the remainder of GILTI would be taxed at half of the already now lower corporate tax rate. And then you add on top of that the fact that GILTI was designed as a global regime, not country by country, which allows offsetting between high and low tax countries and also increases the incentive to offshore. So clearly some major features there.
I'm over my time. Senator Crapo.
Well, thank you very much, Mr. Chairman. The discussion you just had doesn't take into consideration the fact that TCJA increased the base and that corporate tax receipts were record highs after the passage of the act. But that's not what I'm going to get into. Mr. Morris, I want to get into Pillar 2's disparate treatment of investment incentives with you. You talked about that. There are many egregious pieces of the OECD deal. The one piece I just can't wrap my head around is why the administration agreed to the arbitrary and disparate treatment of investment incentives in calculating the minimum tax. Non-refundable tax credits that have historically been used by Congress, such as the R&D tax credit, receive punitive treatment under the agreement compared to refundable credits, subsidies, and other grants that are used more commonly in other countries, particularly China. Mr. Morris, what is the tax policy rationale for treating two tax incentives, even if they are incentivizing the very same activity, differently? And how does this disparate treatment impact the U.S. companies and their workers compared to foreign countries?
Thank you very much, Senator. That's a great question. I wish I could give you the policy rationale for that. There is an accounting rationale, apparently. That is the way that refundable credits are treated as against non-refundable credits. But that doesn't seem to fully answer the question. As to the effect of that, as you say, if somebody is granted a non-refundable credit, then the way that that impacts them is that it reduces the U.S. tax, or the tax, I should say, which they can claim. And as I said, there is a big difference between the U.S. tax base and how Pillar 2 is calculated. And what that means is the credit, when taken out, will lower the ETR, the effective tax rate, and therefore other countries under the UTPR, this other provision, can then be taxed by other countries. However, if you receive a grant or a subsidy, that's added onto the income line, and the benefit of that does slightly increase your tax, but is much, much less than what happens if you pull it out of the tax line. So what that means, in short, is that businesses in those countries which receive grants or incentives will be advantaged, whereas businesses in countries which receive non-refundable tax credits will be disadvantaged, with the result, effectively, that credits in countries such as the United States can be taxed in other countries.
Well, thank you. And I'll follow this same general line of thinking with you, Mr. Bunn. The administration says the OECD Pillar 2 model rules are final and use that to try to justify why they can't negotiate improvements to them, while at the same time the OECD continues to roll out new administrative guidance which in reality modifies Pillar 2 rules in significant ways. For example, earlier this year, OECD's administrative guidance provided for the first time that a foreign country's QDMTT, their qualified domestic minimum top-up tax, has priority over controlled foreign corporations such as the U.S. GILTI regime. The bottom line here is that OECD sanctioned a pathway for each foreign country to enact its own 15% domestic minimum tax, and Treasury agreed to give this tax priority over U.S. GILTI taxes. What do you believe will be the impact on the U.S. fisc?
Thank you for the question, Senator. So there's one point about the dynamic nature of the guidance, which has been essentially a moving target since the original model rules came out back at the end of 2021. And we're actually not sure when the final static nature of those will be complete. As far as the GILTI regime, the original model rules put controlled foreign corporation rules ahead of the domestic top-ups, and then this more recent administrative guidance moved GILTI down the line. I'm not sure why our Treasury agreed to that, but I think the effect, to your question, will be a reduction in GILTI revenues. Back in 2017, the Joint Committee scored the changes and the adoption of the GILTI regime towards the end of the budget window would be raising more than $20 billion in tax revenue. I'm not sure how much that should be scaled down based on the adoption of qualified domestic minimum top-ups, but even back in 2021, we were modeling changes in U.S. tax revenues based on an assumption that countries would react and increase their rates, even though we didn't know what a QDMTT would look like. And in every scenario we looked at, even current law or proposed rules at the time, the introduction of foreign top-ups or foreign changes to corporate taxes would increase those countries' share of revenue and decrease GILTI revenues.
Well, thank you. My time has expired, but it just seems to me that the outcome is going to, as you described, the outcome is going to be that a foreign country can collect revenue that would be in the United States under its QDMTT from its companies and could literally funnel money back to those same companies in the form of government subsidies. So it seems to me that we've agreed to a very bad deal.
Thank you, Senator Crapo. Senator Stabenow.
Well, thank you very much. And I'd like to really return to what I think for the American people is the most important part of this discussion, because it is a really bad deal, but the bad deal is that the American taxpayer is still paying the highest prices in the world for prescription drugs, even though Big Pharma was one of the biggest beneficiaries, as we've all been talking about, of the Republicans' 2017 tax law, which amounted to about 40% tax cut for the industry. My small businesses didn't get that. Individuals certainly didn't get that in Michigan. But what adds insult to injury for me is that pharma argues that they need to be able to fund research, but taxpayer-funded research contributed to every single one of the 356 drugs approved between 2010 and 2019. We helped pay for that while we're still paying the highest prices in the world. Taxpayers gave these companies more than $230 billion in research funding during that time. Research funding, and I support that. I support getting these new prescription drugs in treatments on the marketplace. But at the same time, our Republican friends gave them a 40% tax cut, something that everyday Americans didn't get. And did prices go down for prescription drugs? No. So that is my concern. Drug prices have increased by 3 times the rate of inflation. We pay 3 times higher in the United States than other countries. Insulin costs 800% more than any other developed country, even though it was developed over 100 years ago. And so we could go on and on. But I will say this. It's important to know that there is some good news here on the price front. Several months ago, Democrats took action to lower prescription drug prices in the Inflation Reduction Act. We capped, as we know, the cost of insulin for people on Medicare at $35 a month, hundreds of dollars in savings for seniors and others. We capped out-of-pocket costs for Medicare beneficiaries at $2,000 a year, which will be phased in. We're empowering Medicare to begin to negotiate drug prices, finally.
Yeah.
And we capped Medicare Part B, which is the prescriptions that you get in a doctor's office or in the hospital, infusion treatments, cancer treatments, and so on, at the rate of inflation, which already in 3 months has resulted in prices being reduced by as much as $370 per dose. So we are moving forward to try to put the American people first on all of this. But at the same time, we have to go back again and talk about Big Pharma paying their fair share of taxes like everybody else. And so let me ask on that point, Ms. Ring, we did put in place a corporate minimum tax of 15%. And we are trying to move forward to actually make sure that Big Pharma is paying their fair share. But how would you suggest that Congress build on the corporate alternative minimum tax so that Big Pharma is no longer able to run from truly paying its fair share of taxes?
Thank you for the question. We already have GILTI, and so that's one place. If we make the moves to shore up GILTI, both in terms of the tax rate and the country by country, that will go a long way towards, I think, addressing the concerns that have been identified here today. Also, just with reference to CAMT, the corporate alternative minimum tax, at present it's anticipated it will probably apply to no more than 150 companies. And in terms of its actual operation, it's also not on a country-by-country basis, so the same kinds of underlying operational concerns that we have with GILTI being effective as a minimum tax resurface there as well.
Thank you. Mr. Seltzer, we've spent a lot of time, President Biden and Democrats in Congress and in some number of bipartisan bills are focused on bringing jobs home. That's what we've been focused on, whether it's by American provisions in the infrastructure law or the incentives for manufacturing that we've done in the CHIPS and Science Act and Inflation Reduction Act. We're working to bring supply chains, bring jobs home, but you've been talking about how the 2017 Republican tax law actually spurred Big Pharma to do the opposite and other industries to offshore instead of onshore. And I wonder if you might speak a little bit more about what the incentives were in those policies to move production and profits offshore.
We'll try in a very short period of time. The incentives fundamentally are the fact that you can get a GILTI 10.5% tax rate, or even a less than GILTI 10.5% tax rate if you have some big tangible assets like factories offshore, and you're going to be paying 21 in the U.S. So a pharmaceutical company that developed a drug in the U.S., that produced the drug in the U.S., that kept its intellectual property in the U.S., would basically be taxed at 21% minus any research and development incentives. That same company using an offshored intellectual property structure, an offshore production structure, would bring its tax rate down to around 10. That's exactly what we observe with all the big pharma companies paying tax rates of about 10 and actually not paying any tax in the U.S. And we see this in the size of our trade deficit in pharmaceuticals. It's gone nothing but up. It's now $100 billion. And that's a trade deficit with Switzerland. That's a trade deficit with Belgium. It's a trade deficit with the Netherlands. It's a trade deficit with Ireland. It's a trade deficit with high-wage countries which we can compete with. The reason why we don't is because the tax law now in place strongly incentivizes pharmaceutical companies to produce outside the United States. I said in my testimony, and I really believe it, that offshoring our biopharmaceutical manufacturing base is in the long run a threat to our national security. I think on a bipartisan basis, we should find solutions to this.
Thank you. Thanks, Mr. Chairman.
Senator Grassley.
It's about pharmaceuticals and international tax policy in general.
Senator Grassley, you are next.
Yeah. Thank you, Mr. Chairman. Thanks all of you for testifying. I'm leading up to asking a question of Mr. Morris. The United States originally entered the OECD negotiations with bipartisan support in response to the nation's implementing a so-called digital service taxes that unfairly got U.S. companies. The U.S. Trade Representative determined these extraterritorial taxes to be discriminatory and inconsistent with international tax principles and our bilateral tax treaties. Now, just over 2 years later, foreign countries continue to threaten digital service taxes. At the same time, foreign countries are threatening to impose additional extraterritorial taxes on U.S. companies, an invitation of the Biden administration, pursuant to Pillar 2 of the so-called undertaxed profits rules. So, Mr. Morris, I kind of see the OECD as kind of a super world government trying to impose something against the Constitution of the United States. You can tell me if I'm wrong on that, but could you elaborate on how the so-called undertaxed profit rule runs afoul with our bilateral tax treaties? And if it's a violation of tax treaties, you'd think that whatever they're proposing to do would have to be proposed to the Congress of the United States for our approval or disapproval.
Thank you very much, Senator Grassley, for that question. And let me first thank you for the leadership you gave as chair of this committee and ranking member, I believe, in relation to digital services taxes. Those remain a problem, but let's put those to one side. So on the UTPR, a number of distinguished lawyers and academics have expressed a strong view, yes, that UTPR is contrary to US and many other countries' tax treaties, specifically to Article 7, Article 9, and Article 24, which is to say business profits and the non-discrimination clauses. In short, what they argue is that the UTPR allows other countries to tax profits not arising in that country, but arising instead in the home country, and that is totally contrary to treaty policy. Now, obviously, as you'll have read in other testimonies, these are honestly held opposing views, which is why I indicate that there probably will be litigation. But to the point that you make, Senator, it is absolutely the prerogative of the Congress, and in the case of treaties of the Senate, to make those changes. And so far, those changes have not been made. And one of the problems with Pillar 2 and the UTPR is that that takes place with national legislation. There is not at the current point a treaty involved in this. So making those treaty changes will have to be done on a bilateral basis. And obviously, so far, that has not been done. And just one final important point. Really, any damage to the tax treaty network should be avoided because it'll only damage cross-border trade and investment and the growth and jobs that that creates. So I applaud you for raising this question, Senator, and I do hope that we can all work on it.
And I'm going to lead up to a question for Senator Mr. Bunn. The administration claims that Pillar 2 global tax framework will end, and I quote, a global race to the bottom, end of quote, with respect to corporate taxes. However, in reality, Pillar 2 may simply shift the focus away from a competition based on low tax rates and traditional tax incentives towards one based on providing direct cash subsidies. Can you discuss how Pillar 2 places its thumb on the scale in favor of direct cash subsidies and how that advantages global competitors like China?
Thank you for the question, Senator. You're absolutely right. The design of the global minimum tax rules put a preference towards cash grants, direct subsidies, and a preference against the non-refundable credits that the U.S. tax code has generally used to incentivize different business activities. This is pretty transparent, looking at some jurisdictions and the way they're planning to implement the rules, that they are planning to use some of the revenues they raise from the top-up taxes and turn those into direct subsidies for businesses. There are some countries that have large state-owned enterprises that receive all sorts of direct subsidies and support or below market rate loans from the state that will be essentially outside of the scope for these effective tax rate calculations. So whereas a U.S. company that is benefiting from either foreign-derived intangible income or non-refundable credits or some other policies might see a top-up, other countries might just be giving cash directly to businesses and not having those subsidies subject to a top-up.
Thank you, Mr. Chairman.
Let me thank all of our witnesses. Mr. Stetzer, you point out very clearly that the 2017 tax bill with a differential rate of 10 plus for offshore income will set up an incentive that companies have figured out how to use in order to reduce their overall tax rate. And then we are now talking about the Pillar 2 global minimum tax, and we shouldn't be surprised that because the United States tax code doesn't really harmonize with the international taxing regimes, that we are finding it a challenge based upon the way that we've constructed our tax code. But let me just point out a fundamental problem in this debate. The United States, among the industrial nations of the world, relies less on governmental services than most of our other countries that we compete with. But we don't harmonize in the way that we collect our revenues. You won't be surprised, my fellow members of this committee, that I think we should move to a progressive consumption tax. Now, I want to differentiate that from some of the discussions that are taking place in the House of Representatives today. That is not what I would subscribe. I'm talking about a progressive consumption tax. So on the corporate side, when we recognize that we have higher marginal rates than the industrial nations of the world, if we had a progressive consumption tax, we could have lower rates than the other countries of the world. Therefore, removing the challenge we have as to how we can make sure that American companies or foreign companies that are relying on American consumers pay their fair share of taxes. So, Mr. Tester, I agree with you that we have a challenge. I'm not so sure it's as simple as you think for us to correct it, because every time we correct it, there's some ingenious way that companies figure out to get around this taxing system. But the question I want to ask is more fundamental to the pharmaceutical industry, and that is this. It's inconceivable for me to believe that the pharmaceutical industry is not producing the drugs that we need here in America, considering the profits they're making in America. But in 2022, there was an additional 160 drugs that were now national shortages in America, the United States, adding to what we already have for a total of 295 drugs are in drug shortage in America that are not complicated to produce, but the profit margins aren't as good as other drugs, so therefore we don't have the treatment for, in some cases, cancer and other diseases that are the drugs of preference. So as we provide incentives for investment, and we do in the international arena as well, where we give certain incentives for investment, but there's no accountability. How do we bring accountability into the system so that we know American consumers are going to have the medicines they need? You mentioned the national security issue, which I happen to agree with you. How do we make sure that that's included in how we develop our international taxing regimes?
Senator, I think you've identified what is indeed a very important issue, one I've actually given some thought to. I think when thinking about how to strengthen our biopharmaceutical manufacturing base, we need to differentiate a bit between those who are producing generic medicines at low profit margins and generally are not offshoring to Ireland or Switzerland. To the extent that they're offshoring or drawing on foreign production, it will be from India or from China. And the subset of companies with patent-protected medicines that charge very high prices and that generally now produce in low-tax jurisdictions. For the generic medicines, I think we need to be creative. I think we really need to think about how we create national capacity for emergencies that assures there's enough capacity here in the United States to meet our vital needs for that subset of essential medicines. I don't think we've quite gotten there. I think the Biden administration, through its work on supply chain security, is making important steps. For internationally produced, high-cost, patent-protected medicines, changing the corporate tax code is the most efficient way of bringing production back in the United States. The current incentives have obvious effects. We see it in the trade data. We see it when all the large American pharmaceutical companies are now making investments in Ireland in their capacity. that capacity could be here. And that makes it easier to develop other offshoots, other drugs as well. I'm over time, but I would note that in my testimony, I did suggest linking a restructured research and development expensing provision, making it Pillar 2 compatible, but also limiting it so that companies that move the intellectual property that's created with our help, with taxpayer help, to their offshore subsidiaries lose the benefits of that expensing. Thank you.
Thank you. Senator Johnson.
Thank you, Mr. Chairman. Mr. Bunn, in your testimony, I think you laid out the success of the 2017 tax reform by saying that we pretty well stopped inversions and we had an enormous amount of repatriation of earnings. I mean, weren't those two primary goals of the 2000 tax reform?
I would say those were part of it. Additional growth and investment in the U.S., in addition to bringing those earnings back and broadening the base, were also kind of part of the goals.
Now, I think one of the goals of what we're trying to do here is we want to maintain the freedom of individuals to be able to invest globally wherever they want to invest, right? And isn't that the problem we're grappling with here? Because people have that freedom, they're going to invest where it makes most economic sense for them to do so. So we have to create incentives for them to invest here. My problem with the 2017 tax reform is we reformed the code, but we didn't take the opportunity to simplify and rationalize it. And that's what I'd like to talk about, because I mean, this discussion here today is unbelievably complex. I'm an accountant. My wife's an IRS agent. You guys might understand this. I don't think anybody listening to this possibly could. So I'm asking people to start thinking outside the box. You know, how can we simplify and rationalize this, recognizing the fact that we want to maintain the freedom of individuals to invest wherever they want to globally. And from my standpoint, the way we recognize revenue here is based on the power of our market. You know, Senator Cardin talked about a consumption tax. That'd be certainly one way to very simplify everything and make sure that we get our fair share, and people can't really game the system because you're going to tax consumption. Working with the Tax Foundation, you may or may not be aware of one thing I proposed back in 2017. 95% of American businesses close are pass-through entities. I don't think these problems exist that we're talking about here. I mean, I know this is a big deal, but let's beat up on Big Pharma, who I'm not a real fan of. But I don't think this really exists with pass-through entities, does it, these issues, in terms of international taxation?
There are different challenges for partnerships and pass-throughs, but usually the C Corps have different opportunities with the corporate code than what you would have with the individual code.
So again, my proposal was to turn all businesses into pass-through entities. In other words, maybe a simpler way of talking about it is tax all business income at the ownership level. It's entirely possible to do. There are some complications, but somehow 95% of American businesses figure out how to do it. We've talked to the shareholder services companies that service large corporations that this would be a relatively simple thing for them to do versus other things they do for their big corporations. If you haven't, again, I wouldn't be surprised if you haven't really thought about this, but thinking about it now, would that be a possible solution here?
Senator, I like that you're thinking outside the box here because we like to do that at Tax Foundation as well. Earlier this year, we released a report on a type of corporate integration, which is similar to what you're proposing, that would tax business profits when they are distributed from the business and dramatically overhaul and do some base broadening on the individual side. But this would be a revenue positive and pro-growth reform that simplifies things dramatically. Our model for this is Estonia. We use a ranking of the tax codes of different countries around the world, and for years, Estonia has been at the top of our list. So we looked there for tax simplification proposals, and we modeled that for the U.S. economy, and like I said, it's revenue positive over the budget window and pro-growth. And I would recommend that you continue this work.
Okay. Mr. Morris, do you have any comments? Have you thought about this at all in terms of, again, how do you simplify and rationalize our tax code? And to me, that is the direction we ought to be moving. I mean, first, talk about simplifying, rationalizing it, and so many of these problems, I think, would go away.
Senator, it's a great question. I would agree with that in many ways. We take tax legislation, we then build something on top of that, we build something on top of that, and then we build something on top of that. We don't always take the time to strip stuff away and to figure out what might be sensible. I'm obviously biased here, but I do think occasionally stepping back and having a tax policy discussion about what makes sense, as opposed to how we do the next thing, would be appropriate. And again, I would just echo Mr. Bunn and thank you for doing that thinking.
Can I just give the other two witnesses an opportunity if you want to comment on simplifying and rationalizing our tax code and encouraging this committee to do that?
I will take you up on that. So I think without doubt, the tax code is exceedingly complicated, and I see that every day. I would say it didn't happen overnight, and it happened because taxpayers are creative. And we go back to the 30s, and we see the initial anti-abuse regime starting to be layered in as we try to figure out what to do. So it's a long-standing problem, and it's one that, collectively we as taxpayers, individual and corporate, have contributed to. With respect to your specific suggestion, pass-through, there's a lot of, I think I'll highlight two quick concerns, but, I think any sort of deeper conversation about reform is always important. A true pass-through is challenging, and I agree we do it now with many, many businesses, but we also see that our ability to audit complex partnerships is exceedingly poor at present. So if you move the remaining large multinationals into that structure, I'm not sure that we're going to land where we hope to be without other kinds of reform, either both partnership rules and IRS resources.
Well, I'm happy to scrape the hull of the ship of state clean rather than add an additional barnacle. So I'm happy to look at all this stuff in terms of simplification. Thank you, Mr. Chairman.
Senator Langford's next, followed by Senator Casey.
Thank you to our witnesses. Thanks for being here to be able to walk through this. I've expressed a lot of concerns on just international tax and what Treasury is currently proposing with Pillar 2 especially. Lots of concerns here, and I apologize, we had some other things going on and was not able to hear some of the other conversation earlier on this. But I'm just going to ask some pointed questions on this and try to be able to figure out. Mr. Morris, I want to talk a little bit about just the international portion of this in the treaty aspects and the current treaties we have on tax, and how Pillar 2 is being addressed here. Pillar 2 seems to be an agreement of how we're going to do taxing on American companies, but the United States Congress doesn't get to be a part of it, and it doesn't have to be consistent with previous tax treaties, and we can violate other tax treaties to be able to create this new agreement. I'm trying to figure out the legal standard that's being addressed here and the major problems that are here for American companies that are coming based on an international tax policy that didn't come through Congress that will definitely cost them billions of dollars in new taxes to other countries, as well as how that stands with our existing treaty. Do you have any comments on that?
Yes, Senator Langford. Again, it's a great question. Those are very powerful observations. We do know, or at least we think we know, that one of the problems with Pillar 2 is that it's enacted through national legislation. There is not an overarching treaty here. Such a treaty would obviously come before the Senate, and that would resolve, were it to be consented to, that would resolve those issues. But we have not gone through that process, and therefore everything has to be done by national law. And as you look at it, that does appear to conflict with tax treaties that the US has, and indeed many other countries have, with each other, which will be potentially overridden by this, or at least pushed aside, I should say. And there are a number of issues with tax treaties. There are at least three provisions, one relating to business profits, another to associated enterprises, and then a final one to non-discrimination. And there have been a number of lawyers and academics who've pointed out problems relating to all three of those. Again, these are issues which should be straightforwardly addressed by the Congress, by this committee, by the Senate Foreign Relations Committee, to work through those issues. Because again, as you say, there are benefits to other countries, there are potentially disadvantages to the US and countries like the US in this process.
Yes, significant disadvantages to U.S. companies that are in this. And every time that we've had anyone from Treasury come before this committee, we've asked, what is your plan to bring a change in tax treatment for American companies to Congress? And it's always been, we're working on other options. And other options are not consistent with this pesky document called the United States Constitution and the other treaties that are out there.
I have a I have a copy of the Constitution in my bag, Senator, I promise you. But let me address that issue about the Treasury, because I do talk about that slightly in my testimony. I do think because, as you've pointed out, not just the treaty power, but also the origination clause and the power to amend taxes lie firmly with the Congress and in part with this committee, that it would be entirely appropriate, in fact, it might be desirable, for there to be a formal process for the Treasury to work with the committee, to be instructed by the committee and the Congress on how to proceed in the future. And then hopefully this type of issue wouldn't arise.
Yeah, and it should be. And what's interesting to me is if you do it with national law, then we're actually dependent on the election in every one of those countries at any point. 2 years from now, there can be a new leadership that's elected in any one of those countries, and their platform could be, we're going to tax less in our nation to be more competitive, and suddenly you've got outliers in this. So this new national law is dependent on consistency in every single one of the nations that are in it. There's no binding effect on this. And so it's confusing to us to try to figure out how they're trying to be able to create this new treaty-like something without actually having a treaty and without actually coming back through Congress in the process on this. Mr. Bunn, I want to ask you a question on this as well. I'm also amazed at the way that this is set up and being negotiated currently by Treasury is that they're focused on other nations that do subsidies, can do subsidies, but if we do low-income housing tax credits going to an entity, or if we get back to doing R&D tax credits, which we need to do again, if we do those are not counted. So literally American companies that then get the benefit of low-income housing tax credit or an R&D tax credit are going to now have to pay an additional tax to a foreign entity because they get to decide if we're paying enough taxes in the United States, even though their companies are doing subsidies. So it's this bizarre system where other countries decide what's the best on our tax code, and the big economic competitor here, China, is left completely out of this negotiation. So we're trying to figure out, this hurts American companies. Typically, tax law actually benefits the United States and United States workers. This new tax policy seems to benefit other nations, especially China as the outlier, and literally undercuts every company that does low-income housing tax credits and everything else. Where am I wrong on this, Mr. Bunn?
You're not wrong, Senator. I think the challenge here comes with what we were discussing earlier with the decision to, okay, well, if there's going to be an effort to harmonize tax rules, well, maybe we use an accounting tax base, and then once you have accounting rules in play, then accounting rules don't match up with normal tax principles, and therefore the refundable credits and the subsidies get treated differently than the non-refundable credits, and that's a loss to the U.S. tax incentives and U.S. taxpayers.
Thank you, Mr. Chairman.
Senator Casey.
Thanks, Mr. Chairman, very much. I appreciate our witnesses here, and sorry I wasn't here earlier for the full measure of your testimony. I think it's not shocking for Americans to hear that unlike the average family out there paying taxes, corporations have just raw power to design and to implement legal maneuvers and other tricks they can use to lower their taxes. The offshoring and profit shifting that we've seen in the pharmaceutical industry is just emblematic of a much wider problem. In 2017, the Congress rewrote the tax system to prioritize shareholders over average Americans paying taxes and international corporations over workers. So there's an awful lot of frustration and anger out there, and I think we all understand that. Mr. Setzer, I'm going to direct maybe two questions to you. The IRS reports that American companies booked $60 billion, with a B, billion, in profits in the Cayman Islands in 2019, more than Canada and China combined, as you made reference to in your testimony. Only 68,000 people live in the Cayman Islands. Do you think it's possible U.S. companies actually generated nearly $1 million per person in the Cayman Islands, or is that American money they should be reporting here?
Well, I guess there are two logical possibilities, Senator. One possibility is that workers in the Cayman Islands are just so much more productive than workers in the United States, and every worker in the Cayman Island and every hour they work seems to generate like something like $1 million in profits.
Yeah.
I think the other possibility is what should be America's tax base and showing up in the Caymans. I believe that's America's tax base. I think we've let a very large share of our tax base migrate into offshore low-tax jurisdictions. We make it far too easy for companies to take intellectual property developed in the U.S. and move it abroad. And I honestly think a lot of that intellectual property and the royalties on it, if it's moved abroad, probably should be taxed at the U.S. tax rate, the headline tax rate, not this special tax rate.
Yep. Well, it's abusive and it's destructive when we don't have tax laws that result in higher revenue when we could. I was also going to ask you about the tax bill that Congress passed in 2017. It lowered the top rate on certain corporate foreign income from 35 down to 10.5. Did these tax cuts succeed in getting companies to report their revenues in America instead of tax havens like the Cayman Islands?
The overall answer is clearly no. In aggregate, American companies are still reporting something like $300 billion in profits in the main tax havens around the world, only like $50 billion in profits in like France, Germany, India, Japan, real countries. Now, there are a couple of companies, to be precise, that have repatriated some of their intellectual property. Both Google and Facebook, and I think Qualcomm, did repatriate their intellectual property, now have a more US-based tax system. But there's some really big, really important companies that have not. Apple has not, still an Irish-based tax system. Microsoft largely has not. And best I can tell, all of the large pharmaceutical companies have not. Moderna, which is a much newer company that grew and developed a really innovative vaccine with a lot of American taxpayer support, is a bit of an exception. Their tax structure is based in the US. They haven't offshored a lot. But there's an enormous amount of offshoring in the pharmaceutical industry, and there's still a decent amount of offshoring of profits and the like in the tech industry.
Finally, Ms. Ring, last year we had the Inflation Reduction Act passed, 15% corporate minimum tax. This reform ensures that largest corporations are paying taxes on the profits they report to their shareholders. In your view, will this corporate minimum tax help reduce both avoidance and force companies to pay more of what they owe?
It's a first step.
Your mic.
Pardon me. It's a first step. I think the CBO scored it to reduce the deficit by $238 billion. But as you noted, it's going to apply to not an enormous number of companies, probably less than 150. It also has a design that's still country by country and not, it's global and not country by country. So the same concerns we see with GILTI resurface here in terms of incentives to offset high and low tax jurisdictions. So I think it's a starting point, but really we would be looking forward, to think about those kinds of questions again.
Great. Thanks very much. Thanks, Mr. Chairman.
Senator Young.
Well, thank you to our witnesses for being here today. I've previously shared some of my frustrations with the administration, particularly Secretary Yellen, as it pertains to the administration. It's handling the OECD Pillar 2 negotiations. I highlighted my concerns specifically with the undertaxed profits rule. This rule uniquely disadvantages U.S. businesses. It allows foreign countries to tax the U.S. activity of U.S. companies. Again, for those who are watching these proceedings, this rule would allow foreign countries to tax the U.S. activity of U.S. companies. And these concerns are just the beginning. I have been actively involved here on the Hill, working with my colleagues on a bipartisan basis to ensure that we're investing in strategic sectors of our economy so that we can lead in these sectors moving forward and outfit our warfighters with the latest, greatest technologies. On the private side, we need to continue to encourage investments in R&D. Senator Hassan and I have introduced bipartisan legislation that would enhance R&D tax provisions in our tax code. Given this bipartisan support, I was really alarmed to see the Biden administration agree to rules at the OECD that would substantially diminish the value of our R&D tax credit. This is at a time where if you invest $100 in R&D here in the United States, you can deduct $10. In China, invest $100, it's a deduction, super deduction of $200. So that's who we're competing with. The OECD Pillar 2 rules confirm that non-refundable tax credits, like our R&D tax credit, receive far less favorable treatment than government subsidies and refundable tax credits offered in many other countries. This means that U.S. companies, which heavily invest in domestic research, an activity with a long history of strong bipartisan support, could be subject to additional tax by foreign countries because they qualify for the R&D credit, while foreign-based companies, either receiving a refundable R&D credit or direct research subsidies from their own countries for the exact same activities, are protected from a foreign revenue grab under Pillar 2. So, Mr. Morris and Mr. Bunn, I'll ask you both to respond to this question. Will Chinese companies receiving direct subsidies for research activities from the Chinese government receive more or less favorable treatment under the OECD agreement than U.S. companies taking the U.S. R&D credit? Mr. Bunn, we'll start with you, sir.
That is correct, sir. The way these rules are structured put subsidies in the income line, and non-refundable credits directly reduce the effective tax rate. So you're going to have the UTPR clawing back the tax benefits for non-refundable credits, whereas the top-ups wouldn't have as large of an impact on direct subsidies.
Thank you. Mr. Morris, I'll repeat the question again. Will Chinese companies receiving direct subsidies for research activities from the Chinese government receive more or less favorable treatment under the OECD agreement than U.S. companies taking the U.S. R&D credit?
Senator, thank you for that question. I'm going to actually answer it more broadly, which is that all countries which give their companies grants or subsidies will come off better than countries like the United States, but probably mostly the United States, who have non-refundable credits. And therefore, we do place our own businesses at a disadvantage under these circumstances. And to the point that you made earlier about the need for economic development, it appears that this is not completely joined up.
Thank you so much. I wanted to get each of your perspectives. I, of course, wanted to get your thoughtfulness on the record. I'll continue to make the argument that this is highly unwise tax policy. It's inconsistent with our competitiveness as a country and even our national security. I do expect that once people realize the implications of this so-called undertaxed profits rule, we're going to see bipartisan animus to the ill-advised undertaxed profits rule. If there's any hope of Congress acting on these matters, it'll only be after Treasury returns to the negotiating table to work out an agreement that actually serves the U.S. interest of U.S. workers and their employers. And failing that, I fear we're headed for more tax and trade disputes that will only undermine our collective economic interests. Thank you, Chairman.
Thank you. Senator Blackburn.
Thank you, Mr. Chairman. I want to stay with the Pillar 2 topic and talk with you all about that. I think one of the things that has concerned me is how this administration has entered into these negotiations. They've done it without congressional consultation, and they really have strayed from a lot of the bipartisan objective of the OEDC. And I am concerned about these provisions when you look at what is happening with OECD. A lot of these provisions are going to run into conflict with what Congress has passed, how we've acted on tax treaties, and it's also going to lead to double taxation. Now, this UTPR really allows foreign entities to come in and tax us, they're not paying their share. We did a chart breaking it out just to have a better feel for actually what would happen to U.S. companies under this structure. And American companies earn almost 39.6% of all the income that is targeted under the rules of Pillar 2. And it will disproportionately impact American companies and exceed our share of global GDP, which was 24% in 2021, according to the IMF. When you look at other countries and how those countries are going to fare, Chinese multinationals account for 7.6% of the income that UTPR could target. French multinationals, 2.9%. German multinationals, 1.6%, respectively. They account for 17.9%, 3.1%, 4.5% of GDP. No other foreign country has a more disproportionate share of income targeted by GDP share. The U.S. has the greatest environment for business formation in the world, and that is because we have chosen not to use the tax code to punish our businesses. The damage that this plan could have on American businesses is laid out right in front of us. And I'm not sure about you all, but I do not see how anybody would think that this is a good idea for productivity and business formation and innovation in the United States. So, Mr. Morris, I know as the former chair of the OECD Business Tax Committee that you've been a part of these negotiations from the beginning. And during the negotiations, was it ever mentioned that these proposals would lead to American companies receiving a disproportionate share of the tax burden?
Thank you, Senator, and thank you also for this very helpful chart. The answer to that is, at a number of points during these negotiations, a number of disadvantages to not just the United States, but to some other countries as well, who have a system like the United States, was pointed out. I think, to come back to one point that you made at the beginning of your remarks, one of the problems with this project is that at no point has the Congress been meaningfully involved. And therefore the concerns that you've raised, which could have been raised during the negotiations, have not been raised. And therefore in my testimony I suggest a way of doing that. The point that you make here, however, is incredibly important. As you say, the amount of income that US corporations have at stake is disproportionate as it relates to GDP. But this also brings us back to this important point that we've been discussing, which is that the way that the other rules operate, and in particular in relation to non-refundable credits and the UTPR, means that that can be taxed elsewhere.
Yeah, let me follow on. Mr. Bunn, let me ask you, have you all done any work on how this type scheme, what kind of effect it would have on incentives and subsidies to U.S. companies? And also, have you all looked at the effect of this GMT, the effect of this chart on businesses in particular states, like businesses in Tennessee? Because when I'm out and about in Tennessee, I hear a lot about the fears of GMT, the fears of Pillar 2, the fears of the UTPR, what that is going to do to companies.
Thank you for the question, Senator. Our work is ongoing. We are trying to identify the U.S. tax base risk or at risk to the UTPR. And I'd say another set of challenges that companies are facing right now is just the complexity of it. The amount of data that they have to pull together that they currently do not have in the tax department to be able to comply with these rules or to potentially report no additional tax, but just to file is immense. And that's something that I think is, just the sheer complexity of it and the risk to the U.S. tax base, and we are currently working on products that will highlight those.
Thank you. We'd like to see those as you complete them. Thank you so much.
Senator Warner.
Well, thank you, Mr. Chairman. And I have to say, you look really good sitting in that chair. And I don't know if I've got Senator Wyden's proxy, but if we could leave you in that chair a little longer, maybe you'd reconsider your tenure of service.
We might have a deal here.
You might have a deal here. I can see Ron, if Ron is anywhere watching, his head's exploding at this moment. You know, we are obviously deeply involved right now in trying to make sure our country doesn't default. I think the hypocrisy of the House proposal, where they make massive cuts and then try to ignore things like veterans or Customs Border Patrol and others that would be cut, is a little.
I hate to interrupt you, but you brought the chair.
I know. I thought if anything would get him rushing back, you know. Ron, I'm just saying, it should be a trade. If Ben would stay, he'd get to sit in your chair a little more often. But the notion is somebody who's been involved in these kind of debt and deficit discussions for years, the idea we're going to fix this on one side of the balance sheet only, and that being on the spending side without looking at the revenue side, is kind of absurd. And I've heard some of my colleagues, and listen, I want to compliment my friend Senator Young. I mean, I'm all for the R&D tax credit and believe we need to do other investments. But what we're faced with right now, and the reality, I'm going to come to you, Ms. Ring, because it's interesting you seem to have been avoided by some of my colleagues' questions, is that 140 nations have been working for years on an effort to try to avoid tax avoidance by tax havens. And we have, in our country, a 21% corporate rate, and you know, we'll see how well implemented, a 15% minimum rate that was put in as part of the payments for the IRA. But with these 140 countries working to make sure that we don't leave money on the table that could come to the United States government, do you have any sense, Ms. Ring, Professor Ring, that with the UK, the EU, Japan, Korea, virtually every partner we have, whether we like it or not, is this new international tax regime, Pillar 2, going to be implemented?
Yes. Every indication is going forward, and just this week, Australia outlined its timetable. So I think to your really underlying point, we need to appreciate the seriousness. And it's quite honest, it's the seriousness of something that we asked for. We asked the global community to join us in a minimum tax. They have done so, and now it's moving forward.
Right, and is there any indication, I know some of my colleagues are saying, well, why don't we just reopen this whole negotiation? I know China's an outlier as well, but the idea that we're going to reopen this whole negotiation at this point in time, is there any indication that any of the countries that are in the process of implementing this are going to be saying, hold it, United States, because as you said, we wanted this minimum tax to make sure that people were not using the Irelands or the Caymans or others, are going to reopen a full negotiation?
No. The regime as sort of already embraced by the countries, I think, is really where they are. What we are seeing at this point is implementation rules and details. I think there is space for continuing conversation, but it's at the level of regulations, not the big picture.
Right, but that implementation process, and I know this, this is complicated stuff. The chairman and I and Senator Brown last year tried to put forward some framework on international taxation. This is, if there was ever a case of the devil's in the details, it's this. And we've seen, and I really question some of the 2017 part, but I think even the biggest advocates of 2017 would acknowledge they didn't get it all right on guilty. So the thing that bothers me, Mr. Chairman, is I feel like much of our multinational business community in America is burying their head in the sand, somehow acting like this is not going to come. I would encourage them, and anybody who's sitting here or watching, engage with us. Engage with us on both sides of the aisle. The idea that if we throw a temper tantrum, we're going to somehow avoid this happening. The world is moving forward on Pillar 2. there are ways that we can implement this that does not penalize American multinationals. There's ways we can implement this that make sure that we collect our fair share of revenues. The idea that we're going to simply wish this away or will this away is not rational, not thoughtful. You know, my door is open to any international entity that wants to make sure we implement this right. The sooner we get back to the table, the sooner we meaningfully engage on this, the better American business will stand. And at the end of the day, the better we will do in terms of collecting our fair share of revenues. Because if we don't engage, otherwise these revenues are going to, all the horror stories that we hear on the other side, they're still going to get collected, but those revenues are going to go to other nation states. So again, for our lobbying friends and more importantly for the folks who are watching, let's implement this in an appropriate way. We asked for this proposal. I think at the end of the day, having that minimum tax will avoid the tax avoidance that too often takes place. And again, I appreciate the chairman giving me the extra minute.
I thank my colleague. I just want to say one thing, and then we'll go to Senator Scott. I remember there were town hall meetings in rural Oregon, and it was early in the morning when you, Senator Warner, Senator Brown, and I were all on a call. And we said we are going to advance today a centrist policy, a policy that we thought would appeal across the political spectrum. It didn't have everything in it that each of us three, Senator Brown, you, and myself, would have put in. But I remember on that cold morning when I was headed to a town hall meeting in rural Oregon, the three of us said, this is a position that's substantively right and can help build a broad coalition. So as soon as you said, hey, let's try to figure out how to bring people together, it basically picks up on what we were trying to do when we released it. So well said. Look forward to working with you on it. Senator Scott, please go ahead.
Thank you, Mr. Chairman. I remember a warm day in South Carolina. After the passage of the TCJA, and South Carolinians were celebrating the opportunity to see $4,000+ coming back into the average family's pocketbooks. As a result of the TCJA, we also saw not only the resources coming back to the households by letting people keep their own cash, we also saw a 3% increase to the Treasury with lower taxes. Mr. Bunn, we all know that the TCJA ended inversions and made the U.S. competitive as a location for investment as well as a location for multinational groups to be headquartered. Since passage of the Republican tax bill, there hasn't been a single inversion, and the dominance of foreign acquirers in cross-border mergers and acquisitions transactions has ended. In effect, Republicans helped to flip the script. Question for you is, if we moved the taxes back up to 28%, guilty to 21%, talk to me about the impact.
Thank you for the question, sir. And I was able to be in South Carolina this past weekend visiting family. So
awesome.
Still a great state, sir.
Yes, sir.
The question that you have is connected to competitiveness. What does it mean to be a U.S. headquartered company and be able to invest and earn profits around the world and be able to serve markets here at home and hire and invest here as well? When the U.S. tax code is out of line with our foreign competitors, it creates a disadvantage to be a U.S. headquartered company, and that's what we saw leading up to the Tax Cuts and Jobs Act. Since then, as you say, we've seen a reversal. We've seen U.S. acquisitions of foreign companies grow while foreign acquisitions of U.S. companies shrink. Now, there's all sorts of different reasons for cross-border mergers and acquisitions, but being able to see those trends reverse, as you say, speaks to the competitiveness of the U.S. tax code that is fundamentally different than it was before the Tax Cuts and Jobs Act. Now, there's still room for improvement, especially in the context of the challenges of the mismatches between our rules and these global minimum tax rules. But as you say, we've become more competitive.
Thank you, Mr. Bunn. Thank you, Mr. Chairman.
Thank you, Senator Scott. A question for you, Mr. Setzer, and I think we've got a couple of colleagues. Oh, Senator Menendez is here. I am going to hold off for now. Give Senator Menendez a chance to at least get his materials in front of him and take a deep breath, and then we will recognize him.
Thank you, Mr. Chairman. It's ironic to me to hear that some claim the 2017 International Tax Code reforms raise taxes on corporations. But since the bill passed, large multinationals across the board, including those in pharmaceuticals, but tech and other sectors, are actually paying less tax than ever before. Professor Ring, how much did TCJA cost over 10 years?
Once again, I'm too eager to respond. One way I would put that is TCJA, the CBO score for making it permanent was nearly $3 trillion. So I take that sort of as a big anchor. I also wanted to sort of comment on your point about the rate reductions and the reality of sort of what U.S. multinationals are looking at. A 21% rate, and then what we've been discussing today, often zero on your foreign income is a significant benefit for them from TCJA.
In my mind, the reality is that the 2017 Republican tax law didn't supercharge economic productivity or job growth as promised. It simply lined the pockets of the largest corporations and some of the wealthiest individuals while ballooning budget deficits. It's been 5 years since it passed, and I'm still waiting for it to pay for itself like my colleagues claimed that it would. Does anywhere between a 1.5 trillion if you don't make it permanent, or 3 trillion if you make it permanent, in tax cut for large multinationals sound like a desirable outcome when we're trying to create a fair corporate tax system?
No, it's certainly not fair. The U.S. has many goals as we think about our tax system, and quite honestly, the problem with the deficit, which is right in front of us, speaks directly to that problem.
Now, one of the consequences when the Republicans rushed partisan tax giveaways are new provisions that have the potential to incentivize U.S. companies to offshore their manufacturing. Excuse me. When manufacturing gets shipped abroad, that means fewer good-paying jobs here at home and a higher likelihood of disruption to the nation's supply chain. Professor Ring, isn't it true that the 2017 Republican tax law now gives U.S.-based companies a tax break for owning factories abroad?
Yes, it does. And we've been talking at different points about offshoring income, reporting your income offshore. But TCJ also gave clear incentives to move your assets, your investments, your operations offshore. So we're not just talking reporting the income, but actually the real activities.
Now, are tech companies taking advantage of that as well?
We're seeing it across the board.
Yeah. So there's a reason that Apple doesn't just happen miraculously end up in Ireland by happenstance. Furthermore, we saw firsthand the consequences of offshore manufacturing during the COVID pandemic, where supplies faced bottlenecks causing higher prices for consumers. My point is, in large part, one, we gave an incentive for people to go abroad. Two, we ultimately have a tax provision that not only does the pharmaceutical industry, but others take advantage of as well. Now, too often, my Republican friends claim that slashing corporate taxes is the silver bullet to increasing U.S. competitiveness, that somehow American businesses and entrepreneurs can't compete with foreign companies without a tax advantage. It seems to me that in order for the United States to outcompete foreign competitors, we need to out-innovate them. With China and others investing more than ever before in research and development, it's critical that the United States continue to invest as well through the tax code. But rather than enhance incentives for research and development, the 2017 Republican tax bill actually went in the opposite direction, and it gutted critical tax incentives like the R&D tax deduction. Professor Ring, what is more beneficial to incentivize research and development, a lower corporate rate or targeted tax incentives to increase domestic R&D investments?
So let me answer that in two parts. First, I would say that the idea that higher rates, and I'm talking within the bands that we've been seeing, are bad for U.S. business, would drive it out. First, I'd say we're now working with a global floor. That was the point of the minimum tax. So to get us to a 15% globally, which then makes the sort of issue of a level playing field and competition different than it's been prior to Pillar 2. Also, there's no evidence that higher U.S. tax rates and again, not very high, have impaired U.S. multinationals' abilities to compete. And I cite this sort of the evidence on capital markets in my written testimony. And I think to your point, U.S. markets are an attractive location for a host of businesses for economic, legal, and educational reasons. And part of that is the functioning of government and adding to the infrastructure. Now to R&D, certainly important, and it's been an ongoing focus of our attention for decades. And I think part of it is the sort of the hope, the prospect that innovation is going to transform our lives and also make our businesses leaders. There are a lot of options here, so I think it's the kind of issue that we want to be spending a fair bit of time on. But as we do it, we want to be thinking about the intersection of IP law and those protections for enhancing our R&D, and then to think about the range of other benefits. We've heard earlier today discussion of U.S. direct investment in research, U.S. investment in education at higher levels to support research, and so we can go forward thinking creatively about the various ways that we might want to do R&D. I don't see them as mutually exclusive.
Thank you, Mr. Chairman. That's why I joined Senator Hassan and Young in co-sponsoring the American Innovation and Jobs Act, and I look forward to working with the committee to see if we can make that happen. Thank you.
Thank you, Senator Menendez. And I remember back in 2017, you're talking about what a mistake it was to roll back something like this when we're trying to increase our competitiveness with China. I mean, right at a time when member after member talks about how we've got to be more competitive, you walk back, a very important tool. So I appreciated your leadership, and we're going to get this done. We're going to find a way to make it happen. Senator Warren, you're next.
Thank you, Mr. Chairman. I want to follow up on the questions that Senator Menendez asked just from a little different perspective. Today's hearing is about the tricks and traps that giant drug companies use to evade taxes that occurs against the background of a looming debt crisis. So Republicans in Congress are saying they're going to trigger a default if they don't get to slash vital programs that help families all across this country. For decades, Republicans in Washington have pursued a three-step plan to rig our tax system and jack up the deficit. Step one, shovel tax cuts to the wealthiest individuals and corporations. Step two, slash funding for the IRS so that it can't catch rich tax cheats. And step three, whenever there's a Democrat in the White House, use the debt ceiling to hold our economy hostage. Now, Republicans pretend to care about fiscal responsibility, but the last time they were in charge, they pushed through tax cuts for the wealthy and rewarded big pharma and other multinationals for offshoring jobs and profits. Professor Ring, what impact did the 2017 Republican tax bill have on the deficit that the House Republicans now claim to care so much about?
So CBO scored the 2017 Act as increasing the deficit by $1.9 trillion.
$1.9 trillion. Okay. Because the Trump tax cuts allow giant corporations to pay a lower tax rate than teachers, firefighters, or nurses, our debt ballooned by nearly $2 trillion. So Democrats have fought back. The Inflation Reduction Act that Democrats passed last year imposed a new 15% minimum tax on billionaire corporations, and it provided the IRS with long overdue funding to track down wealthy tax cheats and make them pay up. So, of course, House Republicans are now demanding that we once again gut the IRS, or they're going to trigger a catastrophic government default. Professor Ring, how would the House Republican plan to claw back IRS funding and protect wealthy tax cheats affect the deficit?
So CBO has scored that clawback as increasing the deficit by $120 billion.
Wow. So they want to increase the deficit. And for the cherry on top here, do you know how they'll pay for that $120 billion in increased tax cheating for their wealthy buddies? By kicking 21 million of the poorest Americans off Medicaid, food stamps, and other assistance. That's not all. On the same day that House Republicans passed their disastrous debt ceiling hostage demand bill, Roll Call reported that they are still working to try to extend the 2017 tax giveaways, with plans to unveil a bill this month or next to extend loopholes that big corporations use to drive their tax bills down to nothing. And that would apply to big tech, to big pharma, and to big banks. So, Professor Ring, how much would doubling down on the Trump 2017 tax giveaways to the wealthy and the largest corporations cost our nation?
So I haven't seen any of the specific tax bills that you are referencing, but CBO scored the cost of making TCJA permanent at nearly $3 trillion.
Wow. So increasing the deficit, right, by $3 trillion. So
increasing.
Yes. Even House Republicans who are now, they pretend to care about fiscal responsibility, but they are working around the clock to try to extend the tax giveaways for their wealthy pals, which is what got us into this mess in the first place. Congress needs to pass a clean bill to avoid default. The United States government does not default on its obligations. And as for budget proposals that would reduce the deficit, let's start by closing loopholes for tax-dodging, offshoring corporations, and let's make billionaires pay their fair share. President Biden has proposed a budget to do just that, raising enough money to make critical investments in affordable housing and child care, while also reducing the deficit by $3 trillion. That is the kind of responsible economic policy that we need in this country. Thank you, Mr. Chairman.
I thank my colleague. We may have one or two other members coming, so don't think I'm just filibustering here to keep you in your seats. One of the issues that's come up this morning and also in the past is whether perhaps, I think it was described as cherry picking, and I made mention of the Joint Committee on Taxation, which, if anything, they are not accused of cherry picking. They do it by the book and they focus on the facts. And we've investigated 5 companies, and I think I'll ask this of you, Mr. Setzer, all of which offshored a substantial share of the profits that they earned by charging American patients these extraordinary sums, these sums of money that people actually talk about in coffee shops that they can't afford, and when they're waiting in lines, either at a Fred Meyer or a Rite Aid in Oregon or their doctor's office. This is what they talk about. They don't know all the nuances of OECD and these exotic kinds of schemes, but they sure know when they're getting clubbed over the head by the cost of medicine. And we've heard, well, maybe this is just targeting a few practices and maybe a handful of companies. It sure looks to me like an industry-wide problem. And we asked the Joint Committee on Taxation to look at it from that standpoint. We wanted to have a report that on all of the particulars, especially whether this was an industry-wide matter, that we had accurate facts. And they came back and said 75% of big pharma profits were offshore, and were offshore for the purposes of tax breaks. Mr. Setzer, on this question, I'm not sure you've been asked, this already. Is the committee's work and the work of the Joint Committee on Taxation in some way, any way, targeting just a handful of bad-acting companies, or in your view, does the kind of tax avoidance that our investigative team found, is it something that permeates the entire industry? I'd like your thoughts on that.
Well, Senator, I've read your work very closely. I've read the work of the Joint Committee closely. I've looked quite extensively at the information that large U.S. pharmaceutical companies disclose to their own investors in their 10Ks. And my conclusion is very clear. My conclusion is that this is a systemic practice, that nearly all the the large pharmaceutical companies pursue these kinds of tax schemes, and that it is, if anything, more prevalent in the pharmaceutical sector than in other sectors, which is, I think, also a conclusion that the Joint Committee on Taxation reached.
All right. So one more question, and we've wanted to make sure that our new member of the committee, Senator Tillis, would have a chance to ask a question, so we'll recognize him when he arrives. Also, at home, I'm constantly asked about the relationship between government subsidies and offshore profits. So we've spent the morning talking about how these prices in the United States are higher than anywhere in the world. And also, when this topic comes up at home, people say, hey, our tax dollars are used to subsidize these profits through Medicare Part B, D, to help seniors cover the cost of drugs, and we all know about research incentives and the like. What is the relationship, in your view, Mr. Setzer, between the money, say, from the Medicare reimbursements helping big pharma's profits, and then the companies turn around and send everything offshore to avoid paying U.S. taxes? What's that relationship between government subsidies and offshore profits?
Look, I think any analyst who looks closely at the pharmaceutical industry will come to a couple of conclusions. One conclusion is that Americans pay by far the world's highest prices for a range of drugs. One would therefore reasonably expect that pharmaceutical companies would actually make most of their money in the United States. The profit margins from selling at a high price are generally higher than the profit margins from selling at a low price, yet we don't see that. It is equally a given in the pharmaceutical industry that the bulk of a company's revenue tends to come from the United States for the very same reason. That's true for American companies. Most European companies report that they earn more in the United States or generate more revenue in the U.S. than they generate in Europe. And then the third point, which is universally true, and I think most pharmaceutical companies would recognize it, is that without the funding for a lot of drugs that comes from Medicare, there's no way these kinds of high prices could be sustained. Without the support for research and basic biological processes that the National Institute of Health provides, we wouldn't be the center of innovation. And I think we really need to consider ways of trying to link a little more closely the research and development tax preferences to keeping your intellectual property here, to not shifting it abroad.
My constituents would probably say you're being too logical. So heaven forbid that logic should break out over all this. Senator Tillis is with us.
Thank you, Mr. Chair, and thank you all for testifying. And actually, I want to go down a logic path myself for a moment. I was pleased to hear that Ms. Yellen indicated that in order for us to move forward with this, it'd be subject to congressional approval. Earlier in the process, it appeared as though they were thinking through whether or not that was the case. And, quite honestly, this has no prayer of passing this Congress. So you think about OECD moving forward and businesses who have expressed concerns with it coming back and saying, now with the implementation, we're going to be put into a difficult position, as if for asking for something that would align with OECD. I think I'll start with Mr. Morris. Welcome. What do we need to look ahead once this gets implemented and businesses have some competitive disadvantage? How will we, what would be the easiest way to address that? And do you agree with the premise?
Senator, we are unfortunately where we are rather than where we would wish to be. So the question is right. As I've said a number of times now, if this committee and if the Congress had had the opportunity to interact earlier on this, things might be different, but we are where we are. So this is going to happen. Clearly, the EU has already passed a directive. Countries are doing it, the UK, Japan, South Korea, et cetera, et cetera. And, for US businesses, that's going to be a large part of it. And then, because of the way the rules are currently drafted, currently work, there will be this reach back into the U.S. To recapture tax credits, if you will. It is a difficult situation. There are a number of things which might be possible to do on a technical level. I've talked about potential safe harbors which would carve the credits back out, or safe harbors which would look at the home country jurisdiction, because that seems to be the most difficult and, to put it very politely, innovative procedure here, to be able to reach into a home country's income and to tax that in other jurisdictions where subsidiaries are. There are ways that safe harbors could deal with that. And whether we make other types of credits that the U.S. uses good, or whether we look at other ratios, I think there are possibilities there. But it is going to require the Treasury to go back in there and do that. It is going to require the Congress to encourage the Treasury to do that. And it's also going to require other countries to come back to the table to talk about that. This is not a reopening of the rules. This is actually some of the guidance which is still ongoing. I think that's the best possibility. It's not a great one, but that's the best one.
Mr. Bunn, Mr. Setzer described the Jobs and Tax Cuts Act as a Pharma Tax Cuts and Irish Jobs Act. I've spoken with the National Federation of Independent Businesses. Small businesses constitute about 80% of the job creation in North Carolina. They seem to be saying positive things about the Jobs and Tax Cuts Act and how it's allowed them to invest and grow. So how would you describe the Jobs and Tax Cuts Act? Do you think it's a Pharma Tax Cuts and Irish Jobs Act?
I would disagree with that characterization, and thank you for the question, Senator. As I said in my testimony, the 2017 reform wasn't perfect, but it moved us in the right direction, particularly on the domestic side. I think with the global minimum tax rules coming, with the conversation that you just had with Mr. Morris, I think there are changes that we'll have to, or this Congress will have to consider to make sure that there's not too much friction between our approach and these global minimum tax rules. I'll also say something a little bit about, this concept of profit shifting and what happened before the Tax Cuts and Jobs Act versus what's happened after. There was a lot of shifting of activities to avoid our 35% rate in our worldwide regime to maintain competitiveness with foreign headquartered multinationals. After the reform, some of that has shifted. We've seen kind of a leveling off of what had been a skyrocketing in some of these metrics to capture shifting. So I think that says, well, okay, well now going forward, our company is going to choose to do business here, or have some industries already, set up their footprint abroad and continue to invest
Thank
there.
you. In my remaining 25 seconds, Ms. Ring, you made a comment about maybe a tax regimen for, I think it was directed at pharma and biotech based on their ability to pay. Here's my concern with that concept. They will have an ability to pay, and it will be at the expense of research and development, investigational new drugs, small molecule research. How does a publicly traded company deal with added tax and regulatory burden? They figure out how to take the cost out. You already have said you can't raise prices, so then you have to take cost out, and you have to look at your R&D budget. And if the R&D budget gets cut, their ability to pay that tax increment will. Their ability to investigate or build on Alzheimer's research, ALS research, all the promising drugs in the pipeline will shrink. Thank you, Mr. Chair.
I thank my colleague, Senator Whitehouse.
Thank you very much,
who
Chairman.
I noted in the beginning has spent a lot of time looking at these kinds of tax ripoffs, and I appreciate it.
Thank you very much, Chairman. Let me ask Professor Ring first if there is anything, particularly in the so-called check-the-box department, the Treasury could be doing on its own to help remedy the unfairness that presently is created between big businesses, big corporations that have the wherewithal to go and set up tax avoidance subsidiaries overseas, and regular companies that don't engage in that behavior. What could Treasury do on its own?
So the answer is yes, they can do something. Check the box is regulatory. And when it came in 1997, the focus was a domestic application of that rule and the sort of flexibility for selecting your business form. But it was extended to cover foreign entities as well, but that really wasn't the focus. And as we've seen in the intervening 25 years, that has been a foundational piece of multinationals planning. And clearly, one of the first things we could be doing, in addition to everything else we've discussed this morning, is check the box on an international level.
Thanks, Professor Ring. Dr. Setzer, in the PhD sense, I understand, nobody should come to you if they're having a heart attack here.
That is very much correct.
Got it. So I have a bill called the No Tax Breaks for Outsourcing Act. I don't know if you're familiar with it, but setting aside whether you're familiar with it, do you accept the proposition that when you build this kind of a escape hatch into the U.S. tax code, you give advantage to big corporations against smaller corporations and rivals who simply don't have the scale to have a department of overseas tax manipulation and set up subsidiaries, front or otherwise, overseas?
Well, Senator, I am actually familiar with your legislation. I think it is one of many approaches that would actually effectively address the current offshoring of profits and offshoring of jobs. There's some small differences, perhaps, with the approach of Chairman Wyden and some of the other senators, but fundamentally they both achieve the core objective that we are all looking to do. Both get rid of the huge difference between the GILTI tax rate and the 21% headline tax rate that drives tax avoidance. And by getting rid of that difference and by making it harder at the inception to shift intellectual property created in the U.S. out of the U.S., we can cut off the flow of these tax avoidance strategies, start collecting a lot more revenue in the U.S., and create a lot of incentives for American companies to produce in the U.S. to serve the U.S. market. So I really agree with your legislation.
The three big losers of the status quo are the Americans whose jobs get offshored, the revenues that are lost to offshoring for the public, and the small businesses who have to compete unfairly against bigger companies who've hidden their profits and pay lower taxes as a result.
Absolutely. It sort of is annoying to me when I earn consulting income. You know, I haven't bothered to set up my own corporation, so I'm taxed at the individual tax rate. But I know, actually, because I've been spending a lot of time looking at it, that big multinational companies, some of our most famous companies, get 10% tax rates on their income. And as an individual, I can't get that. All the small businesses I know can't get that.
Particularly with respect to pharma, one of the things we constantly hear when we ask Big Pharma to explain why it is that they insist that Americans pay the highest prices for pharmaceuticals in the world and that they offer the exact same pharmaceutical for lower prices elsewhere, is that, oh, but just think of all the research that we do in the United States. Just think of all the manufacturing that we do in the United States. We are United States companies. And then you look at their financial statements, and the profits are routed or laundered, or whatever word you want to describe. Laundered is perhaps too pejorative, through tax havens overseas. Is that a fair understanding of what they do?
It is an absolutely accurate understanding of what they do. I genuinely believe that American pharmaceutical companies would continue to do research and development in the U.S. if they paid 20 cents on the dollar in to the U.S. Treasury, not 10.
And the smaller ones might have a better chance to compete against the bigger ones among U.S. companies. If I could just close by calling to mind our great friend, Senator Kent Conrad, who was a predecessor of mine as chairman of the Budget Committee and was fond of showing the picture of the building in the Cayman Islands with a name like Ugland House. And it was a very small building, maybe 4 stories high, maybe 10 windows across. But tens of thousands of American companies purported to be doing business there. It was kind of a miracle and gives entirely new meaning to the phrase small business. Thank you.
I thank my colleague. So we've been at it for 2.5 hours or thereabouts, and We've heard a lot today about hugely profitable, massive U.S. pharma companies charging American patients hundreds of thousands of dollars for life-saving drugs while the vast majority of their profits show up offshore. And I have been trying to describe how I think this hearing has unfolded, and I think perhaps at this point I would like to say my colleagues on the Republican side of the committee seem to have attended a different hearing. And it is clear they don't want to talk about what people are talking about in coffee shops all across the country, about how they're looking at this tax cut that gave so many big pharma folks breaks and cut their taxes 40%, and yet they're paying $175,000 for a cancer drug that we've been talking about at length. And I'm just going to close with this. It is very clear that we have to work together to resolve these issues. And this committee has a long history of doing that. Chairman Orrin Hatch, for example, and I worked together on the Chronic Care Act, which in effect changed Medicare to update the guarantee. Nobody thought we had a prayer in the world of doing it. But we said, you know, Medicare's changed. It's not just breaking your ankle, acute care. It's chronic disease, cancer, and diabetes, and heart disease, and strokes. And Chairman Hatch, the late chairman, who was so kind to me, sat here and I sat there, and we wrote it. This committee is capable of doing it. And to give you another very relevant example, Chairman Grassley and I, in 2019, wrote the bipartisan provision to go after big pharma price gouging. Big pharma price gouging. And what we said is when you have these drugs that have been out there for such a long time and you charge more than inflation, you got to give Medicare the difference. Just last week, what Chairman Grassley and I worked on in 2019 was paying really big dividends, lowering the co-insurance costs of drugs like Humira. The newspaper's been listing all the drugs. So we are capable of doing it. And I want everybody to know that I very much appreciate the five of you. Obviously, excuse me, the four of you. I saw the gentleman in the middle. Excuse me, the four of you making very thoughtful points. There are differences of opinion. Guess what? That's what we do in the United States. In a lot of parts of the world, you can't have differences of opinion. Or if you have a difference of opinion with the people who are in charge, they might not hear about you again. So we can do this. These are fixable. A lot of promises were made in 2017. We've been talking about a bunch of them that didn't pan out. And it's not right. And I'll close with this, that these big pharmaceutical companies pay less in taxes, percentage-wise, than do the teachers who come to my town hall meeting. Something's really out of whack there, folks. So we can get these problems fixed. We're going to look forward to talking to all of you. You represent a cross-section of views, and that's how we do our hearings. Senator Crapo and I can have big differences of opinion. But I'll tell you, we're working really hard on this PBM issue to go after the middlemen, hold down the costs for taxpayers and for citizens. So we can do it. And I just want to thank all of you and look forward to staying in touch. Procedural matter questions for the record for all members of the committee are due 1 week from today at 5 p.m. With that, we thank our witnesses. We will excuse you all.